Hello everyone and welcome to this Demica webinar, Demica Insight Q4 2023. Before we get into the webinar proper, I'd just like to go through a few housekeeping points so you know how to participate in today's event. Firstly, you're using your computer audio to listen to the webinar. You are in listen only mode, but we would really encourage you to submit your questions to the speakers as we go through the session. You can do that using the questions pane of your control panel. Tom will be moderating the questions as they come in, and he'll look to fire them at the relevant expert. You can do that at any point during the webinar, and we'll address those as we go through, and we'll also save some time at the end for Q&A. Finally, the webinar is being recorded, and a recording will be distributed to anyone who signed up within 24 hours of the event. With that, I'd like to hand over to my colleague, Tom Huntingford, Managing Director in our structuring team here at Demica, to begin the webinar proper.
Great, thanks, Dan. So we've got a packed agenda for today. Hopefully we have time for everything. The first thing we're going to do is we're going to review the industry sector data that we collect at Demica from all the different programs that we're managing on the Demica platform. We will then go with the panelists through the reason why recently trade receivable securitization have become more and more popular. And lastly, we're going to be discussing key issues that both funders and corporates need to understand before embarking on structuring and executing a TRS transaction. Next. Great, so our speakers today, I'll just start introducing myself. I'm Tom Huntingford, a Managing Director in the structuring team here at Demica. Cliff?
Hi, I'm Cliff Pearce, Global Head of Capital Markets at TMF Group, purveyor of fine corporate services to the securitization market, along with a host of other capital market sectors.
My name's Salim Nathoo. I'm a partner at Allen & Overy, working on receivables financings, supply chain, trade finance, and the like.
Hi, I'm Umang Trivedi. I'm an associate at Allen & Overy, and I'm working in the ICM securitization team, working on various kinds of securitizations, including trade receivables.
Excellent, thank you very much. So as we said, first we're going to go through the data that we've collected, and as a reminder, we always give an update on where the data is coming from. We have around 1,200 corporates data on the platform, and in terms of sectors, it's reasonably diversified with a strong component of computer, electronic, and appliances, merchant wholesalers, mostly in the metal industry, transportation and logistics. We also have quite a lot of programs in that side of things, and then food production and others across. I think this gives a good spread of data, but just to be conscious that obviously it's somewhat concentrated in some sectors. I think we can move to the next one. So in terms of performance, we highlighted 3 specific sectors, which are also linked with kind of themes that are happening today in the markets. The first one is computer and electronics. As you can see, the black line 2020 kind of shifted quite a lot for 21 and 22, very large increase in demand for these type of products. Then in 2023, things have changed, and actually for December, it's the lowest figure for those 4 years in terms of the comparables. And I guess other things to say would be around, we can see some of the shares of these companies, producers of these electronic equipment, and especially underlying suppliers like chip manufacturers having very high valuations, but volumes are kind of giving a different picture. It's not equally spread across the different corporates. We'll see how things go over the coming months and during 2024. Certainly there'll be some uncertainty in terms of how things are going to pan out in this sector specifically. We can move to the next. Transportation and logistics, we have quite a lot of programs in this sector on the platform. As you can imagine, from 2021, things started to ramp up, especially post-COVID, also reflective of very high economic activity across most developed markets. In terms of 2023, though, you can see that the trend has been going lower, but pretty steady. We would say prices, or what we've seen, prices have increased, but quantities have become stable or actually decreased, so there's a bit more pressure. And also in terms of pressure to invest to reduce emissions or to make these more efficient, and also staff shortages are kind of impacting these firms and the cost of that staff, and also means that they need more working capital to compensate for that. And last but not least, paper packaging, different picture again, but kind of an underlying theme of 2023 being a more difficult year across the different sectors that we've seen. As you can see, 2022 fairly stable, 21, 22 high increase in volumes, and since then going down. Some of it due to and kind of linked with the transport side of things in terms of requirement for packaging to send all the shipments, and we will see what happens in 2024. There is a kind of a secular trend in this sector in terms of a downward trend. So it was kind of surprising to see 21, 22 with strong figures, definitely due a lot to that increase in activity, but we'll see how it goes from 2024 onwards. Great. So I think the first topic that we're going to discuss was around why trade receivables are booming. We have kind of prepared a few topics that we want to discuss with the panelists. The first one was around interest rates. So we've seen, as we all know, a very large increase in interest rates across the majority of developed markets, probably excluding only Japan. This has meant corporates and also sponsors have been really looking for ways to reduce cost in their facilities. Free money is no longer available to them, and therefore why the search for lower cost options. This is kind of what has driven that. Another topic that we raised was around the growth in allocation to private credit. Cliff, maybe you wanted to give us some color around that.
Yeah, sure. I mean, as you referred to, with the interest rates going up, we've also seen rising inflation stemming from the quantitative easing policies and supply chain problems. This led many banks to increase interest rates to levels that haven't really been seen in a generation. I think my personal favorite interest rate is the Central Bank of the Republic of Turkey increasing rates to 25%. So maybe things aren't quite so bad here after all. But private credit is looking for sensible low-risk avenues to park their capital. Trade receivables and finance lines are typically very low risk, short-term, self-liquidating facilities. Trade receivables securitization is one of the oldest asset classes and has been a mainstay of the multi-seller conduits for decades now. We are starting to see increased interest in trade finance as an asset class, and this makes sense given the direction of the market. And I think mainly this is because pricing tracks underlying rates which are rising, along with a positive margin component, which represents an attractive return, even against benchmarks like US Treasuries, as an example. So trade finance is an asset class that's highly scalable, offers strong returns. We've got private credit with a lot of dry powder out there looking to deploy it somewhere. We know that governments and export credit agencies are also encouraging investments in trade finance to stimulate economic activity. But it's ultimately the relatively high rates of interest that are embedded in trade receivables securitization that appeal to private credit and belie the short-term nature of the credit risk and the benefit of the inherent credit enhancements actually built into the financing structure. So yeah, in short, it's the relatively high yielding asset, short tenor, transparent credit enhancement, self-liquidating, seeing the increased demand along with that dry powder that needs to be deployed.
Great. I think we also had a point around banks products and how the shift was happening there, Salim. I think you're on mute potentially.
Yep, sorry about that. So I think it's fair to say that many corporates and borrowers have access to sort of revolving credit facilities, and generally banks have historically been quite willing to lend at relatively good rates. But as the interest rate environment changes, the cost of funding go up. Banks have also come under increasing capital pressure, whereby they're holding more and more capital against corporate exposures, and that's just getting worse for them. And so they're keen to encourage, or they're hitting caps in terms of their limits to corporates, and so they're looking to maybe look through the corporates to structured trade assets, so more receivables financings, where they can actually look at a pool of assets and create a different credit story and different capital. Particularly if you go down the securitization route, there are beneficial capital arrangements for banks. So we've seen across the market actually that banks with RCFs encouraging their borrowers to actually shift across to funding through a trade receivable securitization, quite often, very often funded by the same banks that are in the RCF, just because it helps them with their capital and it reduces the cost of funding to the borrower. It's a win-win situation for the banks and the borrowers. Most RCFs will normally have a carve-out anyway in the context of being able to go do a refinancing against your trade receivables, so it doesn't require a huge amount of negotiation. Occasionally that is required, but most of the time, most RCFs will allow that to happen anyway.
Yeah, and I think we were discussing a few days ago a client that actually had an ABL, and banks were pushing for the client, the same banks, to go into a trade receivable securitization because it gave them obviously a different type of exposure and ability to collect ultimately on their borrowing. Another topic that we're discussing was around the sponsor and corporate push to diversified funding sources. So the other side of the coin, instead of the banks, more on the sponsor and corporate side. The allocation that the banks are giving clients when they fund through a trade receivable securitization, especially if it's through a conduit, it's not part of the same bucket, let's say. So it gives them more capacity. It allows them to diversify the type of funding, especially if it's coming from alternative funders also. That kind of expands the total pool of capital that sponsors and corporates can access, and also reduces risk in terms of that ever going away if they have it through different pockets. I think, Cliff, you also had some points around banks' retrenchment on the credit side.
Yeah, so look, we're in a part of the economic cycle where banks are being more cautious on credit. I'm sure they probably won't confess this, but there is a downsizing of credit lines and availability. And until recently, as we said, we've seen rising basis and interest rates. So if you can't look to your local friendly corporate bank for your financing, you're now forced to look at alternative ways of raising funds or being more useful with your business cash flows. So if credit isn't readily available, an alternative is to look at shortening your working capital or cash flow cycles. You can look at shortening your credit terms, but that in turn places pressure on your debtors and customers, whilst also potentially making you more competitive, less competitive, against the market out there. So the alternative is really to look at trade receivables financing, where you can sell your receivables quickly to realize proceeds far more easily.
Great.
Tom, I think just one other potential driver that is really, and I know we're going to talk about this a little bit later, is that there's a positive side that trade receivable securitizations can be structured potentially to be off balance sheet, and so it moves your on balance sheet financing of debt into an off balance sheet sale of assets, and that sometimes can be a big driver, particularly for multinationals. We see that as a big driver generally. Yes. I know we're going to touch a little bit more on that later.
Yeah, thanks, Salim. That's a great point, actually. Great, so we're going to move to the next side of, or the next kind of topic that we're going to be going through. If you have any questions, do put them through the webinar tool. We'll be happy to answer them as we go along, or we'll have a Q&A session at the end. If we can move to the next slide, and the next one. Dan, yeah, thank you, great. So first we'll start with the structure diagram. We won't spend a lot of time here, but we thought this would be useful for people that are attending that may not be so familiar with trade receivable securitizations, just to give an overview of how these are structured so that the rest of the conversation also makes more sense if you haven't looked at one of these before. Very, very simply, there's an originator or seller. So this is a company, for example, producing goods, that is selling the receivables or the invoices that it has to an orphan SPV. And an orphan SPV just means that it's not owned by the originator or seller, just owned by either a charitable trust or part of a trust, or owned by a foundation. So it creates kind of an isolation from the seller, which is important for funders. and for true sale, and that orphan SPV will then issue notes into the senior funders. Sometimes it on-sells receivables. We'll discuss that when we talk about accounting, but the vast majority of the times it's issuing senior notes or loans. There's also a group of companies or service providers that help run the whole securitization, whether that's corporate services, trustee, reporting agent. We'll go through some of those later on. And obviously counsel indispensable to be able to set up and create the securitizations, because they'll be documenting every single step of the transaction. So I think the first topic we were going to discuss was actually documentation. And I think, Umang, you were going to cover this side.
Yeah, that's right. So basically your legal documentation will totally depend on what kind of a structure you're looking at. But what we are going to cover right now is going to be slightly some of the basic documents which you have. In securitization transactions, you typically have an asset side and a liability side of documents. In terms of asset side, you're looking at your receivable sale agreement, which will basically deal with the transfer of the equitable interest in the receivables. Typically, you will not see legal title of the receivables being transferred because you won't have a notice of assignment. But in case you have a notice of assignment, then there is a transfer of legal title as well. And I think we're going to touch upon a notice of assignment later on, whether you have it or not. And Salim's going to take it up. In terms of your receivable sale agreement, you'll be looking at reps and warranties in relation to your assets. The receivables, you're looking at basically indemnities on certain situations when the originator seller will repurchase some of the receivables if it comes to a situation of that sort. Your receivable sale purchase agreement may also cover a few eligibility criteria, which will say what receivables can be sold into the pool, what cannot be sold, and there may be concentration limits depending on the buyer jurisdiction, seller jurisdiction, and also basically depending on asset classes. Another document which is important on the asset side is your servicing agreement that deals with administration of the receivables, collections, and the, how transfer between collection accounts to your transaction accounts will take place. Your servicer may also be responsible for the purpose of preparing reports for investors, which sets out the details in relation to underlying exposures. Moving on to the liability side of documents, just the basic liability side of documents. One of the main documents will be your senior notes agreement, your senior facility agreement, which will contain terms of your senior facilities. These are typically standard LMA form documents, but obviously catered into, like, you'll have additional covenants and reps in relation to securitization regulations. You'll have things like breach, what happens if there is a concentration limit breach. You will have your security documents where the issue will be grant security over their rights in the transaction documents, the transaction accounts, their rights, beneficial title in the receivables, and also the other assets of the issuer if they have any. There's a cash management agreement which comes into place where you appoint your cash manager and they'll deal with all the cash flows of the SPV, because SPV, as you notice, is they don't have a mind of its own, so you need someone to guide them as to how cash flows will work. You will also have an account bank agreement which operates and maintains the transaction accounts which have been opened for the SPV. There may be situations where you will have hedging agreements in place, and that totally depends on whether you have currencies which are different from the currencies for basically, it's not an interest rate swap, it's a currency swap where you're looking at where your invoices are of currencies other than what your financing is of. So there may be hedging agreements in place. Apart from that, you may have some CP documents, which are your standard corporate ancillary documents. You may have a DD report depending on the jurisdictions involved, and also opinions and memos. Back to you, Tom. Thank you.
Great. Thank you very much, Umang. That was very helpful. Another consideration is, obviously, you're setting all of this up, but where is the SPV going to be? And I think, Cliff, you were going to give some thoughts around that.
Yeah, sure. So a lot of this is really going to depend on where the underlying receivables actually located, which jurisdictions we're looking at. So if it's a case of if it's a single country, then that SPV would typically be located there. However, if more frequently, particularly on the larger securitizations we see, in the case of multi-jurisdictional securitizations that include EU and or UK originators, that SPV is typically located in a European jurisdiction, such as Ireland, Luxembourg, or the Netherlands. And a lot of this is really to do with the ability to enforce and the transferability of those assets under European law. So that makes them very efficient from that perspective to be able to locate in those jurisdictions.
I think you're on mute, Salim.
Sorry about I think just to add to that, there are in some European jurisdictions banking monopoly licenses. So the acquisition of receivables by an entity is a regulated activity, and then they have safe harbour legislation that allows you to acquire the receivables in that jurisdiction. So somewhere like Italy, for example, will have what they call a Law 130 or a Law 52 company that you can use to acquire receivables. So in some jurisdictions around Europe, depending on where your receivables are, you might need to use multiple SPVs just to accommodate local law banking monopoly issues. But that's something which, I think is pretty well worn territory now across the European landscape. So generally, there's a very good understanding from investors and from lawyers and other counterparties around how to set those things up. So it's a relatively seamless operation, but nevertheless, just to bear in mind that there are some other considerations around that as well.
Thank you, Salim. That's very helpful. Great. I think the next topic we wanted to cover was around credit insurance, and I think Salim and also Cliff had some thoughts around what they've been seeing in the market around that.
So yeah, maybe I should start with that. I guess many companies already have obviously credit insurance, and usually for particularly important names in their buyer side programs. Ultimately, banks that are funding this stuff are quite interested in being able to get the benefit of those of that credit insurance, and/or may generally, particularly if you're going down to smaller and smaller buyers in the chain, would want to actually just make sure that they have the benefit of credit insurance generally. And so I'd say in a fair proportion of transactions that we look at, the funders are requiring or looking to obtain credit insurance to cover the obligors that are ultimately going to be paying those receivables. And for that, there's a premium and there's a slight cost to managing that, usually something which corporates are already paying, and it's just transferring the benefit of that across to funders. But the credit insurers themselves have very particular rules about how they will want to pay and how they'll note on the insurance policy those interests of those funders. And so there is a little bit of a negotiation to be had with them about making sure the chain of claims works in the right way, that it is actually transferred over to the SPV and or the funders so they can benefit from those.
Yeah, and it's not unusual to see some businesses have a base policy and an SPV policy with the two being linked, which means that they can have the same credit limits applied across the two policies. So the business can choose which invoices they want to sell to the securitization vehicle for financing and which invoices they want to keep without any form of financing. They can then easily oscillate between what they want to finance and what they don't. It's probably fair to say that we see the use of credit insurance being more prevalent in Europe than in the UK. And the reasons lying behind that are probably for another and maybe less entertaining seminar. But certainly the benefits outweigh the costs, better advance rates, better pricing against the actual cost of the insurance.
Great, thank you. I think the next one that we wanted to cover was around structure. And we had three different topics around structure. The first one being funding or advance rate. Here, most of the banks and even other investors that we see are basically using the S&P trade receivables criteria. Sometimes they use Moody's, but the vast majority work on S&P, and they structure the way that the advance rate mechanics work very similarly, with some particularities here and there, because there are a couple of points in the methodology that are kind of open to interpretation. The advance rate is mostly driven by historical performance, and three main components of that are dilutions. So are they credit notes being issued? And then you can get into a lot of conversations around dilutions. Also, depending on who the funder is, they can get into a lot of detail. Are these real dilutions? Are they contractual or non-contractual? Are they dilutions that have become due because there's a cancel and rebill? So the invoice was incorrect, the PO number was wrong. There's a dilution for the whole invoice, and then it's quickly re-invoiced with the right PO, and therefore potentially you want to exclude those. So there can be a lot of background work on dilutions. The other one is aging. Are clients or debtors paying on time? And a lot of the times we'll see either what's called defaulted, which is normally 90 days past due, so have become 90 days past due on a given month, or delinquent. We'll also see ratios of delinquency, which is either 30 or 60 days past due, depending on the transaction. And last but not least, concentration. So how concentrated is my portfolio, and how what's the rating of the underlying concentrations? So securitizations don't work on a debtor by debtor basis, and actually this is very helpful for corporates that have a lot of different clients and potentially wouldn't be able to do it efficiently, kind of a factoring of or a debtor based type of receivables financing. Here you're looking really at the performance of the portfolio, but that also means that you don't want high concentrations. And there's two main things around concentrations. One is the criteria. You have kind of a reserve floor, or you'll get a lower advance rate, let's say, if you have high concentrations, especially in lower rated debtors. Obviously, if you have a AAA or AA corporate at a concentration, that's a lot less of a problem. And then the second one is regulation. There are regulatory limits, especially if you want the transaction to be STS with a 2% concentration limit, and that needs to be abided by. So really helpful for a lot of corporates, but for some of them, there'll need to be special considerations around concentrations. Sometimes we see corporates, for example, agree a separate invoice financing facility with the bank where they have a very large concentration, which would definitely become a problem for securitization. But in most occasions, or in most instances, they're able to work around it with some flexibility from the funder or some alternative kind of way of looking at the concentration itself. And the last thing was around how this is applied, how the funding or advance rate is applied. We have obviously a tier one European securitization bank, especially French banks, which are very strong in receivables securitizations, which will apply mostly the criteria as it's set, with a little bit of tweaks here and there, to an alternative funder that may not want so much complexity and may have either very simple formulas to determine the advance rate, or even have a fixed advance rate and not really following so much, at least on a dynamic basis, the criteria. Then the next topic we wanted to cover was around cash dominion, and I think, Cliff, you wanted to make some points around there.
Yeah, so dominion's a very grand name for a very simple concept, sovereignty or control over cash receipts, but it does sound like a securitization term that Churchill himself could have come up with had he been involved in this market. I believe he was distracted with other things at the time. So cash dominion is the term used to describe the mechanism where the proceeds of receivables are collected by the servicer, which is normally the client, as those proceeds go into the client or the borrower's collection accounts. They are then swept into the SPV collection account on a daily basis typically, and can be applied to then repay the loan, as opposed to actually being transferred across into the borrower's general trading accounts for its own use. Why does this happen? Because the cash received is owed to the investors in the securitization, and so forms part of that trust structure of the deal. So it needs to be swept into the deal as quickly as possible, typically eliminating the daily credit and bankruptcy risk of the receivable originator. And thus control is gained over the cash receipts on behalf of the trust and the secured beneficiaries.
Yeah, and I think I just quickly add to that, you know, from a legal perspective, sometimes operationally it's very difficult for companies to transfer on that daily basis, but partly because they've just got banking arrangements which are complex and sophisticated across a range of different entities. And so quite often there are legal structures imposed that if you can't do it on the same day, to allow it to happen maybe a little bit later, within 2 or 3 days, but with some legal protections to achieve that. And they vary across geography as to how you achieve that. But in the UK, we use declarations of trust. In other places, they have security, or they have other mechanisms in which they collect and manage those collections. But just to add that, I think it's an area where sometimes we sort of need to work closely with companies to make sure it fits the business as to how those collections are being accounted for to funders, but at the same time allow them to work operationally in the way they normally do.
Yeah, I think on our side, we've seen a very wide spread of options, and based on funder flexibility also, and which is driven by the credit of the underlying seller, anything from as Cliff was mentioning, potentially daily or a couple of days later once the cash has been applied in the ERP, to free use of cash during the month, and you only come up on the monthly settlement with the right amount, and we'll be happy with that. So a very wide spread of options there. Great. I think the next one was on sale notification, and Salim, you were going to give us some thoughts.
Yeah, so Umang mentioned that we talk about doing a transfer of the receivables, and that's equitable. And what we mean by equitable is non-notified, really, to the underlying customers. So the underlying obligor customers who are paying those invoices don't necessarily know that that transfer has occurred and that they're actually paying. So they face the original company for that invoice, and they carry on paying them. And that works fine because we've got the collection mechanics in place and everything is moving in line with the structure. But there will come a point where, if there is distress, what the funders will want is to make sure that these very short-dated assets can be collected very efficiently. And so they'll have what they call elevation, or a perfection of title, which is really just means giving notice to the customers that there has been a sale, that they shouldn't discharge the payment back to the original company that invoiced, but actually now to this SPV or another agent of the SPV. And so there will be triggers in the deal, normally fault-based insolvency triggers or non-performance triggers by a seller, or deterioration of the asset pool by beyond certain limits, that will trigger the ability to go and collect directly from those customers to the orphan SPV. And so there's obviously a little bit of negotiation around when those are, but it's normally points of considerable distress where senior funders will want to do that. But when they do want to do that, they want to move quickly. So sometimes what they'll do is create arrangements that enable them to do that. So they might have, for example, someone sitting in the wings and as a backup servicer to come in and take over collections very rapidly in that sort of distress scenario. And they might have to keep them warm for a little while prior to that happening, prior to actually that distress occurring. So it might be possible that there might be someone receiving data who is ready to go and being kept just in case something goes wrong in the arrangements, and that you do need to perfect that legal title.
Great, thank you, Salim. And no session on trade receivables, or more generally on securitization, would be complete without discussing regulation. And I think, Umang, you were going to cover that one.
Yeah, definitely. Like, what we're going to focus now is on securitization regulations, and like Salim mentioned, you may have other regulatory aspects such as banking monopoly licenses and things like that from a local law perspective. From like some of you would already be aware that EU and UK have specific securitization regulations which deal with securitization transactions. And one of the questions we always get asked is whether the trade receivables transactions we are doing is whether it falls within the definition of securitization or no. And there are a few limbs which you need to fulfill or to become a securitization transaction. So securitization is basically defined as a transaction or a scheme where the credit risk associated with the exposure or a pool of exposure is tranched, and it needs to have three important characteristics. It's one, the payments in the transaction or a scheme are dependent on the performance of exposure or pool of exposures. In this case, your payments will be dependent on performance of your trade receivables. Second is there is subordination of tranches, which determines distribution of losses. So in your situation, like Tom mentioned a while ago about advance rates. When you have advance rates, you need to cover the remaining portion. So it can be by discounting or a first loss tranche or a junior tranche. In that situation, you do have a subordination of tranches, and the transaction shouldn't be, or the scheme shouldn't be an exempt transaction, which is typically the kind of exempt transactions that we're talking about, project financings or vanilla financing transactions as such. So most when these characteristics are met, your trade receivables transaction is going to be a securitization transaction. One of the main important points of securitization regulations is you need to have some risk retention holding, which is basically you need the originator or the seller to hold 5% material net economic interest in the securitization transaction. Apart from that, there are other regulatory requirements as well, like you have some reporting and transparency requirements, but that's more on the originator, seller, or the SPV to comply with, where they'll provide investor reports or monthly reports or weekly report, depending on what you have agreed with. And there are a few investor due diligence requirements as well in the securitization regulations which need to be complied with. That's a basic overview of the regulation involved.
Yeah, just picking up on something that Tom talked about as well, is that there's an enhanced regime under the securitization regulations. So apart from the retention and the reporting requirements that companies will have, there's a regime that provides capital benefits to funders over and above the normal capital benefits they get from securitization, which is sort of called STS, which is meant to be sort of simple, transparent, or standardized transparent securitization tool. And the idea behind that is that you comply with certain very prescriptive requirements in terms of how your securitization is set up and what types of receivables you include. But it's very attractive to funders to get that. So that very often they'll ask companies to do some additional reporting and provide some additional data to get within that regime, because it gives them some additional capital benefits associated with the transaction.
Great, thank you for all the color on the regulation, which I'm sure to other practitioners or other members of these transactions or parties is a bit less exciting, but still something that needs to be looked at. Great, I think the next one was around operational requirements. I think one thing that we can say is that these are sometimes take time to put in place, but the ongoing requirements are a lot lower than what we would see on invoice discounting or factoring or other type of transactions. Recently, I had a client who was very surprised that they didn't need to do anything on a daily basis for a securitization. It was at most on a weekly basis. So there's a few areas to look at. One is, so you want to know what's happening with the receivables, what new receivables you're creating, have the ability to pull out lists. If you're selling receivables, you need to know what receivables you're selling, and with that, all the details around the receivables. So the invoice number, who's the debtor, the amount, currency, the due date, etc. Especially if you end up being in a scenario where the funder needs to kind of enforce notifications and try to recover the receivables themselves or through a backup servicer. You also need to look at, or funders will need performance measures. So what's happening with the book, how many new receivables, collections, dilutions that we were mentioning earlier also, because you need to calculate those reserves, concentrations, and on a lot of transactions, having a view on the rating of the underlying debtors to be able to do that properly. Ratios, so there's normally triggers that are put in place to make sure that the performance of the portfolio is not degrading too much. There are also sale agreements or notices that need to be exchanged, sometimes signed now. I think a lot of people are getting comfortable with DocuSign and things like that, but it's something that they need to be needs to be considered from a practical perspective. And I think, Cliff, you had some thoughts, particularly around collections, waterfall, etc., which would be more of the type of services that you guys are working on.
Yeah, exactly. So, I mean, starting with cash manager, effectively you're acting as the transaction treasurer. So the cash manager will deal with all the payments that come in from originators and servicers and pay out according to the priority of payments. Cash managers must also ensure that they send payment instructions on each of the payment dates in accordance with the payment report, and that's prepared by the calculation agent or the program administrator. So a calculation agent, very similar to, say, to the reporting agent, more limited in scope. Instead of full item level reporting, aggregate balances can be shared by the funder, and only required calculations performed by the calculation agent there. So there's a host of other different roles. There's an absolute sort of smorgasbord, if you like, of roles that are involved in a securitization. And this is where your friendly neighborhood corporate services provider comes in, if only I could think of one. I don't want to be too blatant in self-promotion for TMF, but it's a core business for us. And as a corporate service provider, we can take on all the administrative burden of the overall securitization structure. And those roles include establishing and running the SPV, giving a registered address or a domicile, directors, corporate secretarial work, governance, accounting, and tax work. So basically, all the operational bits that make the structure happen. We're also responsible for the various agency and trustee roles to support the transaction. So yeah, in short, infrastructure and the platform for making the deal happen.
Yeah, I think a lot of the times what we see is that you need a core set of third parties to help you, obviously with the SPV, as Cliff was mentioning. If the funders want independent cash manager, for example, that would be another one, reporting agent, and then sometimes things will come up later in the transaction. Or actually, we also need this other thing in, for example, Italy, as Salim was mentioning, I think one of the most challenging jurisdictions, especially in a multi or international program, European program. To add Italy involves a lot of additional parties to be put into place, especially if you want to set up an SPV, and those will come up potentially later on to be able to provide those services. The good news is that it's a very established market, and there's a lot of help from a lot of third parties that can help kind of put in place whatever is required to make the transaction function. I don't know, Salim, Umang, whether you had any additional thoughts on third parties.
I think we were just going to touch on lawyers because that's our expertise, I guess.
Yeah.
But in terms of counsel on these trades, it's very often the case that the originator seller will have retained counsel to help it negotiate the various documents that are being put in place. The funders will have counsel to put the funding obviously into place, and then depending on where you set up your SPV, you'll have local counsel for the SPV, and then sometimes I think you'll see, and Umang talked about sort of a diligence report, that there will be a little bit of oversight around the enforceability of these claims that companies have established under their invoices, and essentially we're transferring invoices and claims against people in a variety of different geographies. So it might be obligors in Europe, it might be obligors in Asia. Very often we see quite a lot of suppliers in China or Taiwan or Korea involved on these, and or in the Middle East if it's oil and gas receivables. So very often you're looking at exotic jurisdictions and working out, does a sale of an asset in Europe or an invoice against one of those people, can it be enforced in that sale, and will it be respected in the local jurisdictions where those obligors are actually located? And so sometimes there's a little bit of work done to try and understand, certainly for the bigger obligors, whether or not those sales will be respected. And so there are a number of potential law firm avenues in that. The good news again is that it's a well-established market with industry, and there's a generally good understanding for most geographies and most jurisdictions around what needs to happen in almost every place as to transfer a receivable, and so that legal analysis can actually be relatively short and quick because people are very familiar with the issues. But it's more just being aware that that there are other parties in here, and I'll also mention accountants because I think that's something we're going to talk about a little bit more. But if you are looking at accounting as being a particular driver, or you're looking at tax issues particularly, then very often you might retain the services of an accountant to look over the transaction to see what its implications are for a particular company.
Great, thanks for that detail, Salim. I concur on the speed of looking at the legal analysis in the jurisdictions that a lot of banks and sellers participate in, and some other more challenging ones that some corporates come up with, which make for an interesting intellectual challenge, if nothing else. Great. So I think the last topic was around accounting. As Salim was alluding to at the start of the webinar, we see a lot of corporates that want the transaction to be off balance sheet, and by that we mean that the receivable is effectively deconsolidated from their balance sheet, so they have not, they're not raising any financing as such. They're rather selling the receivable to a buyer, and that receivable disappears from their balance sheet. They get the cash in, and there's no liability added to the balance sheet for the notes. This results in a reduction in net debt, which for ratings, it doesn't really change that much because rating agencies normally add them back, but it does help with the financial ratios, and also in certain documentation, depending on how that was worded, it helps them achieve better financial performance metrics. In terms of the analysis, I won't go into the detail. This is A, complex, and B, slightly boring sometimes. So I'd say there's two main parts. One is, do they need to consolidate the SPV or not? So that's kind of the first step. And the second one is, do they need to consolidate the receivable itself or not? And there's a lot of questions around the economic risks and benefits of the transaction. Do they still have all the risks and the benefits? For example, if they're funding the rest of the purchase price through subordinated notes, they're going to incur any of the losses. But if it's structured slightly different, for example, through a non-refundable discount, or there's insurance or something else in place, they may have limited exposure to the risks. And also around control, do they still have control of those receivables, or can we say that they have effectively been sold to a third party that can then not necessarily do whatever they want with them, but if in terms of any variable performance, that would be management of arrears. We see sometimes language added there, or given responsibility to third parties like a control party. Last thing around accounting, and I wanted to leave some time for Q&A, was in terms of the difference between US GAAP and IFRS. There's a very big gap currently as to how those are assessed by auditors and the required complexity, let's say, to achieve the deconsolidation. US GAAP structure that we've seen very frequently is an onward sale of receivable to the funder, and provided, so instead of the senior notes on the right-hand side of the chart, just to be clear, you would have a sale of the receivable to the funder for an amount equivalent to the funding required. And provided you can get the right opinions in place, auditors are satisfied that that meets a US GAAP criteria. For IFRS, quite a bit more convoluted. You need to demonstrate very clearly all the two kind of questions that I raised earlier. And in order to do that, we've seen a combination of either non-refundable discount, where you discount the purchase price for the expected loss plus some variability. So you can say that you've passed on most of the risk and the reward. You could have a control party that can take certain decisions with receivables in arrears. You could have a mezzanine funder also, which increases the amount of non-recourse. So if your advance rate, say, is 80%, and then you have a 10 or 15% mezzanine funder, that brings you above the 90%, which is kind of an important level for when you look at IFRS accounting. And last but not least, insurance, which was also mentioned in the context of trade credit insurance. That was more for credit risk, but you could also look at the insurance side of things in terms of the deconsolidation. So I think that was all on our side. We'll open the floor to Q&A. I already see one question that came a little bit earlier when we had already moved on to the next topic, so I left it for the end, was around the impact on the EU's plan law to cap B2B payment terms at 30 days. I'll open it to the panel and then may add some thoughts at the end.
So almost inevitably, as a legal question, the legislation around timing of payment of invoices has floated around for quite some time, and inevitably the way in which that will get implemented will have implications to timing. I think it won't. I think it will still keep, because most invoices pay within 30 days, and to the extent that they are delayed, and there are usually exceptions for smaller payments and other things, that there's still value in this product, because we're typically looking at those sorts of terms, and you're getting financing. So a lot of the drivers that we talked about at the beginning around the capital benefits, secured funding, cheaper funding, I don't think those go away with a more certain regime around timing of payments. It might make those advance rates even better in some respects if there's better certainty around the likelihood of payment. But we think it's potentially helpful or neutral, frankly, for the types of transactions that we're talking about and the structures.
Yeah, I would say very much the same, in the sense that most of the programs that we work in, we see DSOs, which is kind of the payment terms plus a little bit for delays. Not all debtors pay on time, of around 30 to 40 days. So the average payment term is not very far from that 30-day already. The other thing to consider is that that may also increase the requirement for these type of transactions. So a corporate that before didn't have any trade receivable securitization in place, all of a sudden needs to pay a lot faster, and therefore may decide to finance their own receivables in order to fund any gaps in working capital that they have. So on one side, it may decrease at the margin the size of some programs. As Salim said, also, we're already quite close to 30 days, so it won't be a huge change. On the other side, for those that are more impacted, potentially that would lead to additional transactions in order to fund that working capital. Great. Any other questions from the attendees? So far, we don't see. Here we go. What are the approximate ongoing fees of the SPV and all the service providers, excluding the legal fees for setting it up? I'm sure Salim will be happy we excluded those in terms of the question. Cliff, do you want to start, and maybe I'll give some thoughts on the reporting side of things?
Yeah, sure. So from a corporate services point of view, it really depends on exactly how much work or which roles we're actually undertaking. They're not typically reflected in basis points. They are sort of flat fees. I'm very happy to fill in an RFP for you afterwards if you want to come straight to me. You'll find us beautifully priced for the market. However, you know, it's by the time you add up all the different fees, we're still, I think, very economic for what we actually do for all the different roles. And one of the things we didn't talk about was trustee roles, data trustees. There's normally a setup fee, which is the cost of us actually establishing the vehicles, going through the documentation, getting the structure of this all up and running. And then there's an ongoing fee that's attached to that. But it's probably not the right form to go through sort of the actual individual levels of fees on this.
Great. I'd say on the reporting side of things, normally you'd see that as a basis points figure of the assets, obviously with some minimums, and it's a figure that won't really impact the overall pricing of the transaction. So again, not a huge factor. It's normally not really the reason why you would or would not have a reporting agent. It would be more around the volume of the data, the number of sellers, number of currencies, the funder requirements, all those sort of aspects.
Yeah, I think there's just one, I suppose there's an extra thing to layer in, which we didn't really talk about, but Salim, I know you mentioned this before on STS trades. There is actually a requirement with the European securitizations as well for ESMA reporting. So it's another layer of transparency. And again, that's something that we can do sort of fairly economically. We've got a very good sort of tech solution to that for being able to scrape that through. But again, going back to Tom's point, I think the level of fees that we have on these really don't alter the overall cost with any great degree of magnitude and what we actually do.
Yeah,
I think for what it's worth, my observations generally in this market are that there's a number of very sophisticated providers who've been doing it, you know, very well for a long period of time, TMF obviously included. And I think, you know, it's a competitive market, and so generally speaking, we find that, you know, the providers in this market are usually very high quality. They know what they're doing, and that they can provide sort of one-stop solutions, as Cliff has talked about.
Great, thank you. There's another question from someone called Annabelle around, does trade credit insurance bring you outside the scope of the securitization regulation, as recourse isn't solely limited to the performance of the assets?
The $64 million question. So the short answer is maybe. It sort of depends on the terms of the credit insurance. So it sometimes does, it sometimes doesn't. It will depend on the way the credit insurance has been structured as to whether or not it takes you out or not. But it's very rare for us to see 100% policies. And if you have a sort of 90% policy, you end up with an advance rate. So it may not be a particular issue for, say, a funder who's investing in a securitization where they've got credit insurance because they've essentially credit risk mitigated their position to an insurer. But the insurer and or the originator seller may have got a securitization on their hands. It sort of depends on the terms of the policy.
Great, thank you, Salim. Another question we received was around since the securitizations are incorporated in the EU region, do they need to comply with the ESMA regulations?
Yeah, so if you have European investors within your securitization, short answer is yes, they do, and that's the reporting that we're referring to. There are a number of pre-classified fields that need to be reported on, and that's exactly what TMF would do. We would so one-stop shop. We would look to provide those ESMA reports through to the relevant bodies.
Yeah, it's fair to say that I think the reporting regime is currently up for consultation, and we hope to see a little bit of a relaxation in that space. But that's probably a year or two away. So right now it's quite a very prescriptive regime around how you have to report on templates in the UK and Europe under the ESMA templates. They're very aligned in terms of the reporting you require, but they are very prescriptive.
Yeah, it's worth adding actually, even in the US trades where they have European investors, there's still a requirement for that European ESMA annexes to be completed, and that's been something that's been keeping us very busy as well during this time.
Yeah, I think especially on trade receivables, the reporting that funders normally require is already very extensive. We see anything from how the assets are performing, distribution across sectors of available currencies, debtor countries. And what we normally see is we'll have the investor reporting, which is a lot more detailed than the ESMA templates. And then you will just add an ESMA template either as a tab of the report or as a separate XML file, depending on the funder requirement. That's kind of an extract of the main report. So it's kind of interesting that the regulation's trying to make it transparent when actually the market practice is already a lot more transparent than what the template is. And so it's just a question of kind of fitting from the main report what needs to be in the ESMA report as opposed to creating anything new. Great, I think that was it. We didn't have any other questions. I don't know if the panelists had any final thoughts, otherwise we'll close the webinar.
Well, I just leave this observation really that we've talked about a very complicated set of structures and arrangements, but I would emphasize that this is, as Cliff I think mentioned at the beginning, it's been around for decades, this technology, and people have been using it and it's evolved, but it's basically a well-worn path. There are very established ways of achieving these things. So whilst there are lots of points on the diagram, the infrastructure behind this is very sophisticated. You've got all-in-one solutions from a number of different players, whether as reporting agent or service providers, people like TMF or Demica. But broadly speaking, it's a very effective way of getting funding, which is secured and potentially cheaper than your corporate funding. And so, it can be very attractive. Notwithstanding the sort of number of boxes that we've sort of shown you, I think there's a hurdle undeniably to get into it, but once it starts running, it's actually relatively straightforward.
Yeah, and I think the beauty to it is scalable. So it's as companies grow and the receivable pools grow and fluctuate, once that structure is in place, it's very easy to scale it accordingly.
Yeah. Great. So I think that's the end of the panel. Thank you very much, Cliff, Salim, and Humang for joining. I thought that was a very useful discussion, and we look forward to seeing you on the next one.
Great. Thank you.
Thank you. Thanks everyone.
Yeah.
Bye. Bye-bye.